All right, welcome back, everybody. This is a special edition episode of Portfolio Talks. I'm running solo today. Vishal's not here with us, but I have the team from Bridgeport Asset Management, one of our partners, here with us. We have John Fisher, the president and CIO of the company, and we also have Ian Hardacre, who is the VP of the publicly traded side and runs that part of the portfolio. Gentlemen, thank you so much for jumping on.
Thanks for having us.
Yeah, thanks, Tyson.
Part of the reason we wanted to do this is number one is I really like talking to you guys, and I really like to get sort of the inside baseball from the experts and the actual practitioners who are doing it. But also, this is the perfect timing where we're early, we're about mid-January now, and we want to talk to our partners about what happened in 2024. What were your thoughts on it? At the beginning of the year, last year, they were saying 11 rate cuts and 50-50 on a soft landing. And we came out of the year pretty unscathed. And in a lot of areas, we did really, really well. But I'd love to hear your guys' take on, what 2024 was looking like for you. And then, like, how did we end up?
Yeah, sure, Tyson, I'll start on the public markets. I mean, obviously 2024 was a great year. Market up in the S&P 500, 25%. Following 20% plus year the year before. Technology and financials drove the S&P 500 and consumer discretionary as well. Canada was quite strong as well, up about 22%, following about 11.75% the year before. So Canada was strong. The Canadian market did well with the exception of communication services. The Rogers, the Bells, the Teluses of the world, that was quite a negative sector, but it's not a big part of the TSX. We went into 2024, if I look back, just talking about rate cuts. Canada, we started those in June. We had 5 rate cuts over the year. The US started later. We had 3. They started in September. And as you pointed out, it helped the market, which was expected, but they did start a bit later. So rate cuts, monetary policy was number 1. Number 2, geopolitical events, Russia, Ukraine, always on the first or second page of the paper, conflict in the Middle East. And for us, especially in our Canadian fund, how that affects oil last year and going forward is always a major part, being energy is close to 17-18% of the Canadian market. Number 3, if I looked at it, would be the continued rise of artificial intelligence.
Yeah.
How that affected individual stocks, which was obviously very important, but also how it affects productivity and workforce and the economy going forward. Obviously, the jury's still out on that, and we're probably in the first, second inning there. And lastly, if I think about 2024, it would be about high levels of debt at government. People don't really talk about that, but it's something that concerns me. Government debt's quite high around the world, so. And I can talk about that a little bit more as we go into 2025. To talk about 2025, I think it's going to be your volatility in the public equity markets. Volatility is good for us because it creates opportunity. Stocks get displaced. We do our homework ahead of time on individual securities, and we put buy prices on them, and volatility helps. So while a lot of individuals don't like volatility in the market, it is helpful for long-term returns. The obvious factor going into next year in 2025, is the Trump factor and how that plays out. It's very hard to handicap that in the market. I mean, when he gets inaugurated next week, I mean, we may see something, but the obvious things that we've been talking about, first of all, Trump is like all gas, no brakes, as we know, so anything could happen. Tariffs, deportation of individuals potentially, deregulation, which is generally good for the markets, and how he affects foreign policy. All of those individually, when we look at our individual stocks, we think how it's going to affect it, but it's really hard to handicap that factor. Second, as we go into 2025, valuations are quite high. S&P is about 22 times earnings, so you really need earnings growth for the overall market to work because a higher multiple is sort of hard to see in the S&P 500. I'm still optimistic about 2025, about this year, but we're going to need earnings growth. Thirdly, really how the Fed reacts if we do have inflation in the US, because speculation is we still have a cut or two in Canada and maybe one in the US, but that may or may not be true. And a couple other factors. Obviously, China is always a big factor. Uh, Return to some growth in China is very important, especially for parts of the Canadian market, but for the globe, for all markets generally. And lastly, as I mentioned, in 2024, 2025, it's about government debt as well. It's one of those situations, it's not a problem until it's a problem. And I think that could be something that we talk about a lot more this year. I read an interesting statistic the other day that 3.3 billion people live in countries that pay more in interest than they do on healthcare or education. So I think that's something that we have to think about a little bit more. Canada, if I focus in on Canada, obviously it's been economy's not in a great situation. Unemployment rate is a 7-year high. Productivity is not good. Consumer debt's high. Most of the jobs we create over the last few years have been government jobs for the most part. GDP per capita, as we know, is declining related to productivity. Looks like rates are going lower, which is probably going to put pressure on the dollar. So, and we broke 70 cents, which was the first time in 8 years. So, I mean, that all seems really negative. It doesn't mean you can't make money in the market, but I think it plays into the theme I mentioned earlier, which is just more volatility.
Yeah.
It's not going to be like 2024, where it was basically straight up, with exception of a few days. So that's sort of the outlook for the recap of 2024, which is great for investors, and sort of what we're thinking about for 2025.
Okay, that sounds really good. I mean, everybody wants to see their portfolio go like straight up and to the right, and like make money and have nothing, no consequence. But I think you're right in that those volatilities, those movements in the market, if you're dollar cost averaging into your portfolio, man, I mean, it gives you a lot of opportunity to buy a little bit more. And it's funny how people get emotional. You want both of it, right? You want to be able to get in and be able to afford to buy into the fund, but you also want your portfolio to do extremely well, and a little conflicting.
Yeah. And when you look at our investment style on the public side and the public equities, it's, I say it's growth companies at value prices. So to buy
Yep.
growth companies at value prices, you need one of the conditions would be a sort of a pessimistic market, or sometimes a pessimistic outlook, or volatility would be one of them. Another one would be us seeing a product or a service before the market sees it, or it's bigger than the market expects it to be. And thirdly, just time arbitrage, taking a longer term view than the market, because I think a lot of participants in the market, investors, just think a quarter out, 2 quarters out about sound bites, etc. So for us to buy the growth companies at value prices, we need that volatility. We need some sort of negativity once in a while.
Yeah, interesting. In the last like 10 years, we've been more of a growth market versus a value market, but there was a little spattering of value pieces in there. What do you think for the next like year or two? Are we going to enter into a phase where value may be more in favor than growth style investing?
Yeah, I mean, I think it depends how you define value. I mean, we're not deep value investors. We're looking for high quality companies. We're just sensitive of what we pay for them. Um, I think the market we've had, especially in the US, as we've talked about many times, is just, 7 stocks representing 25 to 30% of the market, and 10 stocks
Yeah,
representing 40% of the S&P 500, which is not, in my mind, it's not healthy. But it's gone on, it's gone on longer than I expected it would in a lot of people. So, and those companies are generally good companies. It's just more and more money flows to them. Uh, I do think we're due for sort of a rebalancing of weights in the market, which would speak more to sort of a value focus.
yeah. Okay, that makes sense. It's sort of been like the tail wagging the dog with those companies, and
Yeah,
yeah, we had Fang, and then we had Mag Seven, and yeah, it's they moved the needle a lot.
yeah, yeah. I
Yeah, I mean,
mean,
I think we're just writing, sort of interject in our quarterly client letter that's coming out, that right now the top 10 stocks in the S&P 500 represent close to 40% of the index. It's at a think at least the 30-year high in terms of the percentage of the index that the top 10 stocks represent. So it's pretty unprecedented. People have been calling for an end to this now for a long time, as Ian said, and there was a bit of a pause in that in 2022. We saw those stocks sell off a lot more than the overall market, but at some point it's sort of got to end. But it's been very difficult calling an end to it.
Yeah, exactly. It's just keeps going on and on. And again, it's like we'd love to see a repricing in the market and see these, be a little more realistic. But then the people who are all in on those ones, are they going to lose 30% of their portfolio? It's not a good place to be. It's not a good feeling either.
Yeah, for sure.
You guys had a clip that came out earlier in the year, Ian, where you were talking about some of the companies that you had invested in. And one of them really stood out because Vishal and I, we speak for the UBC year 3 and year 4 dentistry students. And you had a little blurb on a company that invests in dental clinics. And we thought it was really cool. Can you give us a little blurb on that?
Yeah, on Dental Corp. That's obviously the
Yeah.
name we're talking about. Yeah. So Dental Corp is basically, I would call it sort of a bit of a roll-up of dental clinics in Canada, where the company's been around for a long time. It's been public for probably 4 years, give or take, where they go in, they buy the dental practice, the dentist stays on, they improve the efficiencies. Obviously they have the buying power, etc. And I know from personal experience that a lot of professionals actually don't like running the business side, but they like the dental side, or if you're a physiotherapist or anything, they like that part of the business. So there's a lot of opportunity for them to continue to buy dental practices in Canada, make them more efficient, buy them at relatively low multiples right now, and create efficiencies as they go. The stock sort of came public, did quite well, sold off significantly, and that's when we bought it. So, as I say, growth companies at value prices. It's a very good business. It's one of those businesses, if you could own 100% of the business, you would. Like, you think of the Warren Buffett, how he thinks about things, and if I could own 100% of Dental Corp, I would, because it's just a great business. It grows naturally at 3% plus a year. And then on top of that, could grow at 5 to 7%, right? If you run it well, and you can continue growing it a little bit organic, but mainly inorganically, and trades at 8 times EBITDA sort of thing. So we have a quite a big position in the small mid cap fund.
Okay.
I also think, Ian, that it's probably one of the only publicly traded dental company roll-ups out there right now. Like, on the private asset side of things, we see there's a lot of private equity backed dental service roll-ups. Also similarly, there's a lot of kind of veterinary clinic roll-ups. Other sort of healthcare service roles. But I don't know if there's any other companies, even in the US right now, that are publicly traded in the space. There's some that'll probably end up going public. So it's kind of like a unique sort of niche kind of business.
Yeah, no, that's a good point. And especially in Canada, where we don't have that type of business, I can't think of a public dental roll-up in the US. I know there's obviously there's a public physiotherapy roll-up, but yeah, it's a unique business within Canada. Given we don't really have a good subsector of companies in Canada. So, but as John pointed out, that roll-up space is quite big in the private markets, I believe, right? Especially the vet side, etc.
Yeah, we've actually had quite a bit of intel on the space from our private market investment side of the business. And, Ian, I think, was fortunate in that he was able to really acquire our initial stake in Dental Corp at a very low share price. I think, more importantly, a very low multiple of earnings relative to where we saw the same but even smaller businesses trading in the private market as a multiple of earnings. So it was quite attractive. The stock became out of favor for a whole bunch of reasons at the time that Ian sort of made the acquisition. But, and sort of both sides of our business here talking to each other, the private and publicly traded side, we could see that the public market valuation was actually much, much less on an earnings multiple basis than where we saw companies kind of transacting in the same space in the private market, which, doesn't usually happen. It's supposed to be flipped. Public companies are usually bigger. You've got liquidity. They should be trading at higher multiples of earnings in the same space as sort of compared to, their kind of private market cousins. But in this case, it was actually the opposite.
That's interesting. Well,
Yeah, if
one
you
of my
put,
partners that, sorry,
I was
go
just
ahead,
going to
Ian.
say, if you put that private market value on Dental Corp right now, you'd get probably a 75% premium to the stock price. So,
Yeah.
which, could be a takeout price at some point.
And in fact, it's I believe still kind of majority controlled by its main private equity backer and the CEO of the company. So they're really the ones there that are going to control the ultimate outcome of what happens with the business, whether it gets sold or whether they exit into the public market, maybe when the stock price goes up or something. But it's a fairly tightly controlled business still.
Interesting. We've seen that roll of action happen a lot, and I was going to say that one of my accounting partners, they've grown their practice several times over the last couple of years, and they had done that through like conventional lending and then going out and buying practices and stuff. But they were approached by private equity, and the firm was really interested in somebody that's going to grow to go out and round up a whole bunch of retiring accounting practices for the legacy clientele and the regularity of the income that comes from that. And that is never really something that I thought of, but I guess that is he said that whoever they were talking to on the PE side were really interested in going after accounting practices, and I guess they had a fund for that. And it's not something that I had normally thought about, but when it came across my desk, it's like, man, I guess that is a really good model to go around and invest in all those and then buy them all up.
I think you're going to see a lot of that in the next couple of years here in Canada. It's already started in the States, which is basically private equity backing accounting firm roll-ups. I'm a CPA myself, and I've been out of the accounting world for probably 30 years, but I have a lot of friends that are still in it. And there's a lot of conversations going on in this country about consolidation of CPA firms and services that's already, been occurring in the US, where some of the larger firms are already private equity backed. So it's just another example of where private equity has a role to play in an industry where there's not necessarily a lot of publicly traded players yet, but where kind of private equity is bringing their skills to the table, capital and level of kind of professionalism, so that they can help build sort of bigger businesses.
Yeah, that makes sense. Maybe this is a good opportunity for us to like pivot a little bit and then rewind slightly. One of the things that brought me to BP that I really liked about Bridgeport was that you guys have that portfolio where we have publicly traded that is recognizable and we get market growth, but we also have non-publicly traded or private assets that are built into the portfolio. John, do you want to give a little descriptor of like the philosophy maybe of adding privates into a portfolio and what that means?
Sure. I guess maybe the best place to start is, I came out of the private asset world before starting Bridgeport in 2007. So I'd spent a decade at one of the larger private equity firms here in the country before starting Bridgeport. A number of years ago, I guess it's 7, 8 years ago now, we really tried to give some serious thought to how do we build the best types of portfolios where we're going to do our best to maximize rate of return, minimize risk, minimize volatility. Of course, that's sort of what everybody wants. There's the kind of proverbial typical conversation you have with the client that everyone in our business laughs about when the client says to you, well, I want the maximum sort of return with the least amount of risk. And everybody laughs, even the client that might be saying that. And clearly there isn't any free lunch, but when you look at what the most sophisticated and largest investors in the world, when you look at how they have been constructing their portfolios now for several decades, what they've been doing is really mixing in publicly traded assets, stocks and bonds with various kind of private asset segments. And, you can look at Canada Pension Plan and Ontario Teachers Pension Plan, and they probably each got about 50% of their assets now in sort of publicly traded assets and approximately 50% in the private asset world. And they're really doing that because they want to get an added level of like diversification that's hard to get from publicly traded assets alone. We were just talking about, for example, an industry niche, dental services, that it's pretty hard to get that type of exposure in the public markets. And also, when you put those two kind of categories kind of together, typically when sort of one side of the portfolio is doing well, the other side might not be doing as well, and sort of vice versa, so that they offset each other and lead to a longer term, smoother, more consistent rate of return profile. And we really feel that's the key to investors staying the course. The number one sort of reason why I think investors don't do well investing in stock and sometimes bond markets is that, they end up selling at a low and buying at a high. They get motivated by their emotions, fear and greed. They see that it's a time of market stress. Their kind of portfolio could be down 5%, 10%, 20%. And everything that they're hearing from their next door neighbor or CNBC or on TikTok or some other social media platform is it's only getting worse, right? So they're looking at their statement and they're down a certain amount, and what they're hearing is probably by a factor of 10 to 1 is that they're probably going to lose even more going forward. And the fear starts to kick in, understandably so. Obviously nobody likes losing money. And so I think the question is how can you mitigate those portfolio declines so it's not as scary to clients, and that they will stay the course and think longer term. So I actually really believe by incorporating private assets into an existing portfolio that already has stocks and bonds, it will actually end up translating into better performance for the client out of the stock and bond allocation in their portfolio, because they're going to be a lot less likely to behave emotionally and sell stocks at the wrong time and also buy them at the wrong time. So I mean, I think it's key, that whole behavioral finance piece. I'd say the other thing that's really important when talking about private assets is to just understand the scope and kind of variety of the private asset market. I mean, it's not sort of monolithic. It's huge. There's about $12 trillion worth of private assets under management on a worldwide basis, and that's sort of trillion with a T. So it's very, very large. I would say most of that still, I think the stats probably 80 to 90% of that money is still institutional investors, pension funds, university endowments, large family offices, insurance companies, people like that. But increasingly, private clients, as well as their advisors, are seeing all of the benefits of allocating some of their portfolio to this space for all the reasons that we talked about. But there's a lot of different parts to the market. You can really slice that asset pie down into lots of different components. The easiest one and most, I guess, easily understandable to start with would be just to slice it down into the different types of asset categories. So it includes everything like different types of private real estate, from industrial, retail, apartments. We just invested some money into a portfolio of RV parks here in Ontario, which is a really niche area of real estate. There's entertainment-related properties. So there's lots of different segments within sort of private real estate, which is a segment in and of itself within the private asset market. But you've also got infrastructure, which includes transportation infrastructure, things like the 407 highway here in Ontario. You've got digital infrastructure such as data centers, energy installations. It really runs the full gamut. And then you've also got, of course, private equity. And most people by now have heard of private equity. It's sort of the industry, as I said, that I came out of almost 18 years ago. And that's essentially acquiring ownership into private companies. And so there's all sorts of different strategies within that world of acquiring different types of companies at different stages of their corporate development, different industries, different structures in terms of how you acquire them. And also that obviously incorporates venture capital, which is really a subsegment of, like a subsegment of the private equity world, really just earlier stage kind of companies that are earlier in their growth cycle, more risk, but more upside as well. And then lastly, there's all these income generating private asset strategies, and that can include everything to lending to private companies in the form of private corporate debt, as well as lending against different types of real estate versus owning real estate, which is what I'd spoken about earlier, but you can lend against real estate. There's different royalty types of strategies. We have some exposure to strategies with groups that buy up publishing rights to songs, and every time they're played on Spotify or Apple Music, we are actually on an indirect basis kind of collecting royalties, or if they're played in concert or in a TV commercial. We've got medical royalties that we're earning money off of drugs and other medical products. And then there's also leasing strategies, which is also just another way of earning income from a private asset. And, that's basically leasing assets. So we have some funds where they own aircraft and they lease them out to major airlines all around the world. We have another fund that owns close to 100,000 rail cars now that are leased out to railways and other major shippers, and they're earning this leasing income. So you put it all kind of together, and it's a really nice, diverse mix, and you can get exposure to these asset classes in different geographies around the world, much like stocks. You get a lot of diversification. So one year, maybe there's something that might be affecting lending to apartment buildings in Dallas, Texas, but that same risk may not affect our royalty streams from our music publishing rights. The two things really don't have that much to each other, aren't really kind of correlated with each other. And so we've got about across our three private asset funds, which cover all those categories, we've got about 50 plus different portfolios, exposure to different sort of segments that are all not particularly correlated with each other, which really helps in terms of, again, getting back to earning that consistent kind of rate of return.
Yeah, I think that's awesome. What a way to really explain and expand on the idea that a client's supposed to have a diversified portfolio, but if they only have stocks and bonds, we can only diversify so much. That I think that's pretty incredible the way you explained it. One of the things that that really draws my attention and my favor to a company like yours is all of that stuff that you just listed, John. If a client was an individual investor and wanted to get access to that, I mean, by themselves, how much capital would they have to put up to buy into any one of those strategies?
Usually an individual strategy, the minimum investment with one of the managers that we allocate capital to in each of these sort of specialty areas, it's usually about $3 to $5 million. So to get really appropriate diversification in each of these areas, you sort of need, let's say at a minimum, to actually invest like an institution would, to actually diversify like a real institutional investor would, you sort of need at least 15 to 20 allocations in each of those areas. So you start to multiply that math through 50 plus different allocations, 3 to 5 million a piece. You're getting into the hundreds of millions of dollars, and that's just for your private asset allocation. And we are by no means saying that you shouldn't still invest in stocks and bonds. So you're really just talking
Yeah.
about, oh, I need 200 million to invest into private assets, and you probably want to have 200 million or something like that in at least stocks and bonds, if not more. So you start to think about it. Your math is, I'm really like to do this myself and to do it in a way that really replicates what the most sophisticated and best investors in the world are doing. You're probably a 400 or 500 million dollar total portfolio player. So it's a pretty decent sized family investment office or institutional investor that's going to do that. It's very hard to do it as an individual investor yourself unless you have a reasonable, at least maybe you have 10 or 15 million and you're just going to cherry pick one or two of those investments. The issue with doing that is it may or may not work out well. Like you're not really getting a lot of diversification. You're going to pick one private equity manager with one strategy with maybe, depending what they're doing, 8 to 10 investments. They're making pretty concentrated bets, which is fine, but it's not so great if that's your only private equity allocation.
Yeah, right.
And so it's kind of why institutions don't do that. So we always look to that, which is why would we not try to replicate what the best investors and the most well-endowed and sophisticated investors in the world are doing? Why would we not try to do that for our own portfolios as well as for our client portfolios? Because we do eat our own cooking at Bridgeport. I mean, one of the things that we really feel strong about is that we invest in our own portfolios, and a lot of times, the portfolios that we launch and certainly how we invest those kind of portfolios are to some extent guided by what we want to do with our own personal money, right? And so yeah, that's sort of how we got to where we are here now.
That's awesome. There was one thing that you said in there that really piqued my interest, and it's on my list of questions. It was at the bottom, but it was on my list of questions. He talked about AI data centers. Now, there's been a kind of famous Canadian investor, ran a fund. Now he's in the States. He's on Shark Tank. He's talking about building AI data centers in Alberta. He's making the most noise about it. From a investment portfolio manager point of view, do you guys have any thoughts on that about creating these data centers, trying to get them housed in Canada, building them out, and possibly even investing in them in the future?
Yeah, Tyson, I'll take that. I mean, when you look at data centers and what's required in data centers, Alberta actually would be an excellent place for three main reasons. One, it's business friendly. Two, they have close access to natural gas as an energy source, right? And I think natural gas, especially in 2025, will have a bit of a renaissance. And I think, our portfolios are sort of positioned for that, especially as we get different administration in the US. And thirdly, temperature-wise, Alberta's would be considered a cool climate, which is really important, right? Because the energy it takes to cool data centers is really important. So Alberta has a lot of, and they have the space. So Alberta has a lot of the requirements for more data center build. So yeah, I mean, it's something I was in. I actually go to Calgary quite a bit, but I was there when I was at a conference there in July. One of the big discussions was on the building data centers, and you're obviously aware of it, and I don't know how it's all going to play out, but like I think it's definitely a strong possibility.
I feel like, Tyson, your kind of follow-up question is going to be about whether we think we should become the 51st state, but I don't know.
Yeah.
It sounds like the same individuals pushing that idea, or at least a very kind of closer economic union, notwithstanding tariffs being on the table. But yeah.
Right. Yeah. No, I don't think that's going to happen. I think that's I think there's a lot of noise. It's great to get people's attention, but I don't think it's something that really could transpire. But when talking about like a big, massive infrastructure investment like that, I was just more curious whether you guys think investing in the data center or investing more in like the picks and shovels surrounding it, the construction, the management, the land leasing, all of this stuff, which would be like an area you think portfolio managers would look at.
I mean, I guess all of those. I mean, the direct data center. I mean, there's some public entities in the trade in the U.S. I mean, they trade at super high multiples, and it's not like It's not like that's a big secret, but there's different ways of investing around it. Maybe sort of picks and shovels. It may be, as you pointed, picks and shovels of part of the data center build. It could be anything like that. So we're always focused on that. I mean, while we have a value orientation, it doesn't mean that we don't are on top of what's going on in the world and what the trends are, et cetera, and how we can make money around that, right? So we just have to be disciplined on what we pay for something. That's all.
Yeah.
We've actually got quite a bit of data center exposure through various infrastructure managers that we have allocated capital to in the Bridgeport Private Real Estate and Infrastructure Fund. So
Okay.
it's a big category within infrastructure today, just because there's a lot of demand, I think, for investment in that area. It's growing with AI, obviously, as we've been talking about. It's even growing more. But we have, I'd say, I'd be sort of guessing off the top of my head, but if you told me 20% of the infrastructure portfolio is in data centers in sort of various jurisdictions, it certainly wouldn't surprise me.
Okay. Tyson, we also own Brookfield, and we own Brookfield Corp. We will also own Brookfield Infrastructure in our high income fund.
Okay.
And they have quite a bit of exposure to data centers.
Gotcha.
Yeah.
Okay.
Yeah.
I know we've kind of touched on this, but I kind of like maybe get you to flesh this out with your thought process, Ian. But Goldman and J.P. Morgan, and they released a report at the end of the year. They're kind of predicting S&P 500 returns over the next 10 years to be about 3 to 5%. So not as exciting as it has been in the last 10 years. What do you think that's kind of attributed to? And then how do portfolio managers adjust for something like that going forward?
Yeah, I mean, I haven't seen those reports. I tend not to read them, but as I pointed out earlier, the S&P 500 at 22 times earnings, you're going to need earnings growth. You're not going to have multiple expansion. But, having said that, when you look at our funds, our 3 pure equity funds are 20 stocks in our large cap Canada, 20 stocks in our large cap US, and then about 20 to 25 in our small mid cap fund. And, we're really selective in the stocks. So I'm not as worried about how the overall market does. Obviously, if we have a big sell-off, we'll be affected. Everybody will be, but we're picking individual stocks, so there's no reason why we can't have double-digit returns. If you ask me, is the market gonna do over 20% next year? That would be not something I would probably bet on, like a multiple of 22 times, with everything we're facing in terms of, the tariffs and the factor, the unknown sort of U.S. administration, what they're going to do. I'd be pressed to say we're going to do over 20 times. Could it be high single digits next year, low double digits? There's no reason why that can't happen. The U.S. economy is in a good spot right now, right? So.
Yeah. I think you touched on something that was really good that gives a little bit of insight to your portfolio and portfolio construction. There is a lot of noise, like John was saying, with TikTok and Instagram and stuff about people saying just buy the S&P 500 index or buy an index fund, set it and forget it and never look at it. Whereas you have more concentrated portfolios that are not super diluted through diversification. Can you talk about a little bit about how your selection process may be better or suited for some people versus buying an index fund?
Yeah, there's a couple things there. Like of our 20 stocks, we do keep it diversified by business. So I don't look at risk as volatility, even though when you do look at our funds, they're lower volatility than the market. It's really diversified by business. So, we try and find the best business, the best price within certain sectors. Like we're not going to own 3 companies that do exactly the same thing, right? So that's how you sort of get the diversity in the portfolio of business types that are not correlated. In terms of our process, it's really, I slice it down to a third. It's analysis of the business, moats around the business, competitive advantage, pricing power, what's the historical track record of that business. That's 1/3. Management team, which is a very important part, is a third. So does the management team own stock? Do they act like managers, or do they actually act like owners? And what's their history of return on invested capital, allocation of capital? And then the last third is valuation. So what are you paying for that business and management team? So that's sort of our process. And when it comes to valuation, primary DCF, but we also look at all measures: PE, price to book, enterprise value to EBITDA, breakup value. We use all measures to do that, and then we make a decision based on one third, one third, one third, right? So that's our process, and that gives us our portfolio of 20 companies. But those 20 companies are what we believe are the best companies at that time, at that price, in that industry.
That's awesome. That's a great explanation. Question that I'm going to sneak in here for my female clients is, one of the positions you hold, and I believe it's in your U.S. fund, is LVMH, and
Yep.
high quality, luxury brands company. I like to watch that from the business point of view. Is they're going out and growing through acquisition, right? Like they're like the Nestle Foods, but of the luxury goods world, where they own everything. Can you talk a little bit about like how you got in, what drew you to that company, and then some of the things you might like about it?
Yeah, sure. So there's a few things there. One, it's in our U.S. fund, but it's a European company headquartered in Paris. But we bought the ADR, right? So we can invest in large non-U.S. companies in the U.S. fund. And when you think of LVMH, it has global exposure. So that just the fact that it's headquartered in Paris doesn't really mean anything. Their sales in France would probably be 5% or something like that. When we look at LVMH, and well, the other thing I would like to say is I've met them a number of times. I met them in Paris in their head office over my 30 years of doing this. So I have quite a bit of exposure to it. But until recently, I've never owned the stock because it's always been too expensive. When you look at the stock, let's talk about the business. So as you pointed out, luxury goods, branded, pricing power, big moats around their business. Obviously, leather goods with Louis Vuitton. Then they own Sephora. They own Tiffany, Christian Dior, Tag Heuer, and more brands. So it's a warehouse of global luxury brands, which is an ideal place, and especially if you believe the world. As my coworker Mike says, I mean, he wants to be long rich people. So the business long term is great. Management team, CEO owns 50%. He's the fourth largest person in the world. He owns 50% of the company. But the management team has a lot of depth across their different brands. And then valuation. So we were able to buy it at the lowest PE and enterprise value to EBITDA multiple that's traded in over a decade. And it's really because of the slowdown in China, right? So as long as the company still do well, even if China stays flat or keeps going down, because it's they're global brands. But if China does have a bit of a lift, because 40% of their sales are related to Asia, then the stock will start recovering. And actually yesterday, Richemont, one of the other luxury good players, had good numbers, and LVMH was up 9%. So we were able to buy it at 11 times EBITDA, sort of 18 times earnings, right? Good long-term growth profile, great brands. I mean, that's a good example of how we do things in terms of waiting till the price comes to us, but we know the company.
Yeah, that's awesome. Do they send you any samples or anything so that you get to test out the goods?
No, no $5,000 handbags.
Yeah. That's awesome. I guess this is probably a good place to put a wrapper on it for this time, but I would love to kind of maybe do this once or twice a year to kind of check in. I really like what you guys are doing. We did come off of a great year last year, and so it's easy to have these conversations when you're like, hey, we crushed, and everybody did. But I think this is a great way that not only can we get the information firsthand, like right from the portfolio managers, but also to hear a little bit about why you make your choices and what that means. Gets us a little closer. If I was investing in a Fidelity or a BlackRock fund, I'm not getting a portfolio manager on the podcast to talk about the decisions that they make and what could be next.
Sure.
Yeah, anytime, Tyson. Anytime you want to talk about stocks, I'm more than happy.
Yeah,
Awesome.
anytime at all. certainly happy to be here. Certainly been a pleasure. So no, thanks for having us both on. Really appreciate it.
Fantastic. Did I miss anything? Do you guys want to add anything before we sign off?
Just want to wish everyone a happy new year and all the best in 2025. Given we're still, I think I can still say that 2 weeks in. Yeah, I mean, I think we covered a lot of territory. Ian, you have anything?
No, I did on that. I think that's great.
Fantastic.
Great.
If people are looking to get more information, where can they find more information on Bridgeport or your guys' company?
Probably the website's the best place to go, bridgeportasset.com. Yeah.
Okay.
Yeah, that's probably a good starting point. We're always here to chat, and everyone knows, I assume, we're like you're at as well, so we can both certainly take care of any queries.
Fantastic. Gentlemen, thank you very much for doing this. I really appreciate your time and answering all the questions.
Great.
Okay,
Thanks very
Tyson.
much. Much appreciated. Take care. Have a good weekend.
Thank you.
Bye.
You too.
Bye.